I think that, by the way, that's a very good word, the holistic approach. I think one can break it down into several categories. First of all, the screening universe of what I would call value or potential value stocks becomes much larger if you begin looking at situations holistically. Because there are companies which honestly look like garbage as equity investments until you examine the credit side and you realize that credit is already paving the way to restored profitability. Sometimes even just looking at where the CDS or the insurance on the debt is trading will tell you that the company can accrue value to equity holders simply through, as I had mentioned before, repurchase of debt at depressed prices or reissue of debt. Or that it might be accretive to earnings to actually issue equity to repurchase or pay down debt. I would say additionally that for anyone that is looking for value investments that have a credit-informed side to them, screening processes should inevitably cross-reference different valuation metrics, pure equity valuation metrics. And the reason that I mention that is our typical value screens, of course, will run any number of metrics from price to book, EBITDA, EBIT, free cash flow to firm or equity, and the relevant yields on either enterprise value or yield of the stock for any of those various cash flow or earnings proxies. I find it extremely informative to screen simultaneously on all of these different earnings metrics or multiples and compare them and look at how much of the spread between two different earnings multiples is accounted for by credit. Because it can tell you whether or not you yourself are creating a proxy trade, whether or not your screening process is accidentally creating proxy trades, which could better be done by, or more cheaply be done by purchasing a sector ETF. You might find that you are simply looking at the impact of overinvestment in a sector 2 years ago and taking a lot of DNA up front. Or, there are a number of ways to look at it, but I like to look at companies that screen very cheap on one multiple and average or expensive on a different multiple to understand what the source of the value screening on the one multiple actually is. And frequently it comes from credit. And I make sure that our analysts, whenever there is a huge discrepancy between two value metrics, especially if it's extended over a period of time or it's trending, I ask them to go back and specifically explain why the company is a value investment on one metric and not on another, and what the source of that discrepancy. I call it discrepancy because an equity should not screen as overpriced over an extended period on one multiple and as a deep value investment on another multiple for a long period of time.